Welcome back to History Class with Dr. W. We're continuing our discussion of American history in the years 1920 to 45 and transitioning now from the 20s to the 30s, from the Roaring Twenties to the Great Depression. In this first couple of preliminary lectures, we'll talk about that period of transition from the late 20s to early 30s as the Great Depression began to set in. And we'll start with this preliminary lecture about the stock market crash of 1929. On October 22nd, 1929, the front page headline of the Washington Post read, "Expect Bull Market." For those of you who know a little bit about the stock market and the economy, a bull market is a good thing. So the headline meant expect continued prosperity, expect good times. Just 1 week later, the stock market was in the process of crashing, and the nation was on its way to sinking into the Great Depression. So when we look back on the 1920s, we can see from our vantage point the calm before the storm. We know what's coming in 1929, but people at that time clearly didn't. There were many other predictions, like that headline of the Washington Post that was so terribly wrong. So rather than picturing the 20s in this manner as a calm before the storm, try to imagine it as the people who were living in it did. They had 8 or 9 years of general prosperity. The stock market had been doing very well, in fact, soaring along, and just about everyone expected it to keep right on going. Of course, they were horribly wrong. Herbert Hoover was elected president in 1928. We're going to be talking much more about him in the next few lectures. But in one of the great campaign ironies of all time, he was elected on a platform of banishing poverty for good. So let's talk a little bit about the economy of the 20s, and this will to some extent be review of things we've already talked about, but we need to kind of peel beneath a few of the layers to see how it is that this soaring economy wound up in the worst depression in our history. So just as a reminder, the 1920s was an age of consumerism. The United States was now the strongest producer in the world, so factories and companies just kept churning out product. And as we'll discuss, overproduction was one of the contributing factors to the decline in the economy. We also had very high protective tariffs in the 20s, meaning that foreign products were more expensive than domestic ones. So foreign nations kept getting deeper and deeper in debt to the United States. In the United States, consumers borrowed on credit to buy all kinds of goods, which I talked about in some previous lectures. There just wasn't a lot of cash circulating, and many things began to be done on credit. And as we noted in previous lectures, farmers struggled throughout much of the 1920s, even as most of the nation prospered. Farmers in the 20s just kept on growing products and overproducing, and prices kept on going down. So by the late 1920s, farmers who had already struggled throughout much of the decade were only getting worse. They would have a whole lot of company before much longer. Most textbooks and scholars mark the beginning of the Great Depression with the stock market crash of 1929. And there are aspects of this that are right and wrong. As I just mentioned, for many Americans, notably farmers, they were suffering long before the stock market crash. And many Americans didn't own stock. And so the effects of the overall economy and the market took a while to reach them. But a good portion of the country was directly involved in the stock market crash, and it is certainly the single most obvious sign that the Depression had begun. So we're going to talk a little bit more about the stock market crash itself in some detail, and then we'll talk about how the stock market is tied to the broader economy and how it contributes to the overall depression. So the stock market of the mid to late 1920s had boomed, and thousands of Americans had made fortunes on the stock market. There really was a sense of irrational exuberance, particularly in the last year prior to the crash, as people just kept on buying and buying stock. Stock prices became more and more inflated, and there came to be a general feeling that it would always go up. And in fact, it was almost impossible to lose money investing in stocks. And that, of course, was a fatal mistake. Also, at that time, there was a great deal of what is known as buying on margin. That means that the purchaser borrows money from the bank, you take out a loan, and put it directly into stocks. Now, obviously, if stocks are going up and you're doing that, then you're fine. You're actually making money that you didn't have before. But if the stocks go down, then you lose not only your initial investment, but you also owe the bank the initial loan that you took out to do this. Many people at that time borrowed up to 10 times their initial investment. So if a stock went down by $1, you owed the bank $10. Throughout the 1920s, most investors were fine since stocks were going up. But once the market crashed and they began going down, as we'll discuss, it became a major factor in the continued sell-off. So margin buying doesn't cause the crash, but it does make things much worse once the selling begins. Many people at that time also talked about speculation or gambling on Wall Street. Robert La Follette called it the great American evil of stock exchange gambling. Many people were buying stock in companies that they didn't know much about, and in fairness, at that time, companies were much less responsible than they are now for reporting their earnings and providing other information. So even Wall Street experts who were supposedly in the know didn't have nearly as much information as such people do today, in part because of the crash, and we'll talk about some of those regulations in the aftermath. There were other problems with the market as well. Many companies, especially utility companies at that time, were overvalued. They also created what were known as holding companies. So let's say you start out with a small or normal utility company, then you create another company and sell stock in it that's really just a name. Then you create another, and so on. Businesses sold stock in companies that had so many layers of stock upon stock upon stock. And really the actual company at its heart was worth only a fraction of what all the investors had put into it. So many companies, the utilities in particular, just had exorbitant stock prices at that time. And again, much of this isn't really discovered until the aftermath of the crash and the many investigations that followed. Other companies that saw their stocks soaring during this period were things like the railroads and radio. So then as now, cutting-edge technology were some of the most desirable stocks. A stock like RCA, which was the leading radio company, you could purchase a share of RCA stock in 1911 for $11. In 1928, those same shares were going for $450 a share. And I would just note that still doesn't account for one more year of soaring stock prices between 1928 and 29. Now, in fairness, this is sort of an arbitrary example. A cutting-edge technology stock like RCA, should the stock have gone up in that period? Of course. Should it have gone up that much? It's really hard to say. I mean, we see similar kind of soaring stock prices of internet companies these days, Amazon and Netflix and so many others. Clearly, those companies warrant having a stock price increase, but many stocks in this period had grown to just enormous proportions. By September of 1929, there were signs of a few glitches in the market. A few down days mingled with the general upward trend. And actually the market peaked on September 3rd, so a month and a half, almost 2 months before the crash was actually when the market hit its peak. At that time, the measure of what we call today the Dow Jones Industrial was 381. That was the peak of the market. In August, the Federal Reserve raised the discount rate of interest to 6%. making it more expensive to borrow money and taking a little bit of the wind out of the sails of the market. And so starting on September 3rd, the market gradually declined over the next 2 months. Again, some up days and some down days, but things had flattened out and were starting to come down just a little bit. And we'll talk about what might have happened in that period of 6 to 8 weeks and why so many investors got caught in the market and didn't sell when they still had a chance. On October 24th, which is sometimes called Black Thursday, there was a wave of sell orders and stock prices plunged. Over the next couple days and the weekend and the following Monday, the market dropped even more. Some huge investors poured millions of dollars into the market, attempting to prop things up. But the following Tuesday, October 29th, Black Tuesday, the bottom dropped out. There were some 16 million shares sold, which was just more than the market could bear. By the end of the day, nobody was buying anything as stock prices plummeted. We'll talk more about what exactly made this happen, why so many investors got tangled up in it and couldn't get out, and the impact of the stock market crash in our next lecture.